Welcome to the Trendline Gala podcast.
Hey there.
Today, we are going to walk through something that I think causes confusion for pretty much everyone when they start thinking about their money.
For sure.
It's the difference between investing and trading.
Right.
People use these words like they mean the exact same thing, but they're not. They're two totally different games.
Completely different rule books, different mindsets, everything.
So that's our mission today. We are going to clear all of that up. We're looking at the core differences: time, goals, risk using really, really simple language.
At their core, let's be clear. Both of them involve using your money to buy assets, things like stocks or bonds.
Right.
And the hope is you end up with more money than you started with. That's what we call a profit.
But how you get there changes everything.
Exactly. And we have to start with the big picture risk right away.
Okay.
Here's what we know. Most beginner guides explain that unlike money you put in a bank, which is usually guaranteed up to a certain amount, money in the market is not guaranteed.
Right. So it can go down.
It can absolutely go up, which is what you want,
Yeah.
but it can also lose value. You could have a loss.
Okay, I think I get the basic risk, but I still get hung up on the words themselves. When I hear people talk about putting money into the markets, I genuinely don't know what they mean.
That's the confusion we want to clear up.
Is there, a simple idea I can hold on to remember the difference?
Yes, absolutely. If you remember one thing, remember this: time.
Time.
If you're thinking in years or even decades, you're probably investing. If you're thinking in minutes, hours, maybe a few weeks, you are definitely trading.
Ah, okay. That one word changes everything.
It dictates everything else that follows.
That helps a ton. So investing is the long game, the patient approach.
The patient grower.
Let's break this down then, starting right there.
Let's do it.
So let's start with a really clean definition of investing.
Okay.
Investing is putting money into something and planning to leave it there for a really, really long time.
A very long time. Like you said, years, maybe decades, before you even think about touching it.
An investor just doesn't care what their stock price is next Tuesday, right?
Exactly. They're aiming for growth that happens slowly, steadily. They want to ride out all those little ups and downs that we call market cycles. The belief is that over the long haul, the market generally goes up.
It just sounds so much less stressful.
It can be.
If you buy something today and your goal is to use that money 20 years from now for retirement or maybe for your kids' college, you are an investor. It's a marathon.
It is absolutely a marathon, not a sprint. And we have a perfect way to picture this.
The analogy.
Investing is like planting a tree.
Okay, walk me through that.
It's the perfect visualization. Think about it. You take your seed, which is your money, right?
Right, yeah.
You put it in the ground, you water it, but mostly you just wait.
You're not digging it up every day to see if it's growing.
You are not. You don't see growth every hour. You might not even see it every month.
Mm-hmm.
But over 5, 10, 20 years, that tree grows big and strong.
And that slow, patient process is what investing is all about.
That's the essence of it.
Yeah.
Time is the investor's best friend.
So if we're planting this tree, what are we waiting for? What's the goal?
The goal is building up real wealth slowly for those huge future goals.
Like retirement.
Retirement, a down payment on a house, things like that. The investor is looking for steady, dependable, long-term growth.
Which brings us to the emotional side of it, patience.
Uh-huh.
If you're an investor, you have to be patient. You have to accept that prices will bounce around, that volatility is just normal.
And you can't panic. You just stick to the plan.
Yeah.
That patience is literally the difference between success and failure in investing.
So it's about time in the market, not timing the market. I hear that a lot.
That's the phrase. You're not trying to guess the best day to buy or sell. You just commit to staying in. You have to ignore all the noise, all the daily headlines.
Okay, so if I'm going to buy a piece of a company, how does an investor decide which one to buy? Are they just looking at the price today?
Not at all. A real investor is focused on what we call fundamental analysis.
Okay, wait. What are fundamentals? That word sounds intimidating.
It does, but it's simpler than you think. All it means is you're looking at the deep underlying health of the actual business, not just the stock price on a chart.
So, is the company actually making money?
Exactly. Is it profitable? Are its sales growing? Does it have good leadership? You're looking at the real business.
So if I'm planting a tree, I care about the quality of the soil and the health of the seed.
Perfect. You want to know what the business is actually worth, not just what people are willing to pay for the stock today.
And this is where it gets really interesting. This is the part that makes investing so powerful.
This is the magic.
The concept of compounding.
It's been called the eighth wonder of the world. It sounds complicated, but it's really not.
Break it down for me.
Compounding is just when your money earns a profit, and then that profit starts earning its own profit.
It builds on itself.
It builds on itself. Imagine you invest $100 and you earn 10% in year one. You now have $110.
Okay.
The next year, you earn 10% again, but you earn it on the full 110. So you make $11 in profit. Now you're at 121. The growth actually speeds up.
It's like a snowball rolling downhill.
That is the classic analogy. It just picks up more snow as it goes. And the key ingredient is time. You have to give it time to roll.
Let's use a real-life example of an investor, say, Maya.
Okay, Maya.
Oh.
She puts $500 a month into an index fund. We'll get to what that is in a minute.
She starts at age 25, plans to retire at 65. So this year, the market dips 15%. What does Maya do?
Maya does nothing. She doesn't panic. She knows she has 40 years for that money to recover and grow. She just keeps putting her $500 in.
Her focus is 40 years away, not today's scary headlines.
That's what makes her an investor.
So what are the actual things investors are buying? You mentioned stocks and index funds.
Right, so there are a few main types. First, you have stocks. When you buy a stock, you are buying a tiny piece of ownership in a company. It's an equity security.
Wait, really? So owning a stock means I actually own a tiny piece of the company?
You absolutely do. You have an equity stake. If the company does well, your piece gets more valuable. If it fails, well, your piece can become worthless.
Okay, so stocks are ownership. What else?
Then you have bonds. With a bond, you're not buying ownership. You're loaning money to a company or a government.
So I'm the bank.
You're the bank. They pay you interest for that loan, and then they promise to pay you back your original money later. They're usually seen as less risky than stocks.
Got it. And what about those baskets you mentioned?
Right. Mutual funds and ETFs or exchange-traded funds. Think of these as baskets that hold lots of different stocks or bonds. Instead of buying one stock, you buy a tiny slice of the whole basket.
And why is that so popular with investors?
One word: diversification.
Not putting all your eggs in one basket.
That's it. If one company in the basket does terribly, you still have hundreds of others that are hopefully doing okay. It spreads out your risk.
And the classic example of all of this in action is a retirement account.
Exactly. A 401k or an IRA. They are built on this idea of consistent, long-term, diversified investing.
So what's the best strategy for buying these things over time?
The simplest and most powerful one is called dollar cost averaging, or DCA.
I hear that term all the time.
All it means is you put a fixed amount of money in on a regular schedule, say $200 every paycheck, no matter what.
But why? Doesn't that mean sometimes I'm buying when the price is high?
It does. But here's the magic. It also means you're buying when the price is low. And when the price is low, your $200 buys more shares.
Oh, I never thought of it that way.
Over many years, it averages out your cost.
Yeah.
And it takes the emotion out of it. You're not trying to guess the perfect time to buy. You just keep buying.
It forces you to buy when things look scary.
Which is often the best time to be buying for the long term.
Okay, so investing is long-term, patient, focused on the company's health, and it uses compounding.
That's the formula.
Let's switch gears completely to the polar opposite.
Let's talk about trading.
So if investing is planting a tree, what is trading?
Trading is actively buying and selling assets, often trying to make money from quick price moves.
The time frame is just completely different here.
It's the total opposite. Traders hold things for minutes, hours, days, maybe weeks. They're focused on today, not 20 years from now.
So we need a new analogy, not planting a tree.
The analogy for trading is surfing waves.
Okay, I like that.
The market is an ocean. A trader sees a wave forming a quick price change. They jump on, ride it for a short time, and then jump off before it crashes.
And then they're immediately looking for the next wave.
Immediately. It's constant action, constant attention.
So the goal isn't long-term wealth building. What is it?
The goal is short-term profit, making money from the difference between the buy price and the sell price over and over again. It's about generating income now.
Which means the activity level must be insane.
It's incredibly high. Traders are monitoring markets constantly, watching news, looking at charts on multiple screens. It's not a hobby you check on Sunday. It can be a very stressful full-time job.
And because that time frame is so short, let's talk about risk and loss.
This is a crucial point. Trading is generally much, much riskier than long-term investing.
Why?
Because short-term market moves are basically random. They're chaotic. We have a good idea the market will be higher in 30 years, but trying to guess if it'll be higher in 30 minutes, that's almost impossible.
And you have no time to recover from a loss.
Exactly. A bad trade can wipe you out quickly. This is why so many beginners lose money when they try trading.
So if the risk is that high, traders must have ways to protect themselves.
They absolutely have to. It's called strict risk management. And the number one tool is the stop-loss order.
How does that work?
A stop-loss is an automatic order. When you buy a stock at, say, $10, you immediately set a stop-loss at $9.50. If the price drops to $9.50, the system automatically sells it for you. It cuts your loss without you having to make an emotional decision.
It's like a safety net.
It's essential. It's like wearing a helmet when you surf. Now, remember how investors use fundamental analysis?
Right, looking at the company's health.
Traders do the opposite. They mostly use technical analysis.
So they don't care about the company's financial report. They're just looking at the lines on the graph.
For a pure technical trader, yes. They're not trying to figure out what the company will be worth in 10 years. They're trying to figure out what the stock price will do in the next 10 minutes.
How? What are they looking for?
They're analyzing price charts, patterns, trading volume. They're looking for clues in the price movement itself to predict the next short-term move.
It sounds more like psychology than business analysis.
It's very much about market psychology. One tool traders use that we have to mention is leverage.
Uh-oh. That sounds risky.
It is extremely risky. Leverage is basically borrowing money from your broker to make bigger trades.
So if I have $1,000, I could trade with $10,000.
Exactly. And if the trade goes up 1%, you make 10% on your money. It magnifies your gains.
But I'm guessing it also
magnifies your losses. If that trade goes down 1%, you lose 10% of your own money instantly. You can lose more than you started with.
Wow. Okay. That is terrifying for a beginner.
It's why trading, especially with leverage, is so dangerous if you don't know what you're doing.
So this all sounds like it's not just a financial game. It's a huge psychological test.
It absolutely is. The speed, the risk, it creates these huge psychological pitfalls that cause most beginners to lose money.
Like what? What's the biggest one?
The most destructive is probably revenge trading.
Revenge trading.
Yeah. It's when you have a losing trade and you get angry or frustrated, so you immediately jump into another bigger, riskier trade to try and win your money back.
You're chasing your losses.
You're letting emotion drive your decisions, not your strategy. And it almost never ends well.
I can see how that would spiral. What else?
The opposite problem, almost, is overconfidence. A beginner gets lucky on a trade or two, and suddenly they think they're a genius.
They mistake luck for skill.
And they start taking huge risks, stop using their stop losses, and then one bad trade wipes them out.
So let's put these two side by side. I think a direct comparison will really lock it in.
A cheat sheet. I like it.
Okay, let's start with the big one again. Time frame.
Right. Investing. Years or decades. Long term. Trading. Minutes, hours, days. Short term.
Next up, the goal.
For investing, it's building wealth slowly for big future goals. Retirement. For trading, it's about profiting from quick price moves. Smaller, frequent gains.
Okay, and the activity level.
Investing is minimal. Buy and hold, maybe check it once a year. Trading is constant. Frequent buying and selling, watching the screen all day.
The research style, this is a big one.
Huge. Investors focus on fundamentals, the health of the business. Traders focus on technical analysis, the price chart, and market sentiment.
And finally, the risk style.
In investing, the risk is spread out over time and through diversification. It's still there, but it's managed. In trading, the risk is much higher, concentrated, and immediate.
You know, thinking about this table, an important thought just hit me.
Oh.
If you buy a stock and you tell yourself you're an investor, but then you check the price every hour, you're not acting like an investor. You're behaving like a trader.
That is the #1 beginner trap. That is it, right there.
So you have an investor's goal, but a trader's anxiety and behavior.
Exactly. And that combination is a recipe for disaster. You get all the risk of trading, but with none of the discipline or strategy. You end up panic selling at the worst possible time.
You just turned a good investment into a bad trade.
You did. Your behavior has to match your goal.
Now, even though they seem like total opposites, they do have some things in common.
They do. At the most basic level, they share some key DNA.
First, in both cases, you're buying assets.
Right. You're using money to buy a security, like a stock.
Second, the goal is always the hope for profit.
No one buys the stock hoping it will go down. You're always trying to end up with more money.
And third, the most important one, risk is always present.
Always. There are no guarantees. Prices can and do go down. A loss is always possible.
And one big thing they both share is a major goal in personal finance, right?
The fight against inflation.
The hidden tax that just shrinks your money.
Exactly. If your cash is just sitting in a bank account, it's losing purchasing power every single year because prices for everything else are going up.
And here's what we know. The stock market over the long term is one of the best tools we have to beat inflation.
It's historically been the most reliable engine for real wealth growth. The returns have, on average, been much higher than the rate of inflation.
So getting your money into the market in some form is essential.
It is, if you want to protect your financial future.
Okay. We've defined both approaches. We've compared them. For the beginner listening to this, the big question is, which one should I start with?
It's a great question, and there's a pretty clear recommendation here. For the vast, vast majority of people, the answer is investing. Start with long-term, patient investing.
Why is trading so discouraged for a total beginner?
It's just so much harder. It requires a ton of time, a ton of emotional control, and a lot of specific knowledge. Most beginners who jump into trading lose money, and they lose it fast.
So what's the safe path?
Start with investing. Set up regular contributions to a diversified retirement account, something with index funds or ETFs. Set it and forget it.
And if you're still curious about trading?
Then, maybe later, take a very small amount of money you can truly afford to lose completely and use that to learn with. But don't start there.
The difference in the time and effort required is just huge.
Monumental. Investing can be a few hours of setup, and then you just let it run. Successful trading can be a full-time job.
And if we're putting our money into these markets, who is watching out for us? Who makes sure the game isn't rigged?
That's where the regulators come in. In the U.S., you have organizations like the SEC and FINRA. Their whole job is to protect investors.
And what are the key ideas they focus on to protect us?
Two really important words: disclosure and transparency.
Okay, what's a disclosure?
Disclosure means companies that sell stocks to the public have to make all important information about their business available, their financial reports, their risks, everything.
So I can actually look up how healthy the company is.
You can.
Yeah.
It's what makes fundamental analysis even possible. It's all about making sure you know what you're buying.
And what about transparency?
Transparency is about seeing how the trading process itself works. Knowing the price a stock traded at, how many shares were traded, it makes it much harder for people to manipulate prices behind the scenes.
So disclosure is about knowing what you're buying, and transparency is about knowing the game is being played fairly.
That's a perfect summary. They are your allies in the market.
This has been incredibly helpful. I feel like the fog is finally lifting on these two words.
It's all about time and behavior. If you get that right, you're halfway there.
Let's do a quick final recap using our analogies just to lock it in.
Let's do it.
Investing is the patient, tree-growing mindset. You're focused on building wealth over many years, looking at the health of the company.
And trading is the active wave-riding mindset. You're focused on quick gains, looking at price charts, and it requires intense, moment-to-moment discipline.
And the main takeaway for you, listening, is to know which game you're playing and make sure your behavior matches your goal.
If you're planting a tree, don't check the roots every day.
If you're a beginner and want to learn more about trading and investing, you can take our free beginner trading quizzes at trendlinegala.com. Next time, we'll talk about how markets actually work behind the scenes so you can picture what's happening when people trade and invest. Thanks for joining us at Trendline Gala.